Hello everybody, today we are going to have fun with the ups and downs of volatility in investments. We'll be going over what is volatility, why it matters, how you can protect yourself against it, and how you can use it to your advantage. Okay, so what is volatility? It is the statistical measure of the returns of an asset. This is typically measured as the standard deviation or variance of returns over a period of time for a given asset. In simpler terms, volatility is a measure of how high and or how low in price an asset changes over time. An example of volatility: SPY, a market index of the 500 largest US companies, can deviate up to 3% up or down on any given day. Bitcoin, which is the largest cryptocurrency by market capitalization, can deviate by up to 15% plus or minus in a single day. So you can see the huge difference between these two assets. For example, volatility matters because it tells you how an asset behaves across a span of time. Higher volatility means that the asset has higher highs and lower lows versus a lower volatility asset. Just look at this Bitcoin versus SPY chart from May 2020 through May 2021. Bitcoin is extremely volatile when you compare it against SPY. There are countless ways to protect against volatility in the financial markets. I'll mention 3 strategies that are simple to implement. I am not a financial advisor. The following is for educational purposes only and is not investment advice. The first strategy is to invest for the long term. Think in terms of years. Hold an investment for at least 5 years so that volatility doesn't negatively affect your investments. Think long term. The second strategy is to never invest any amount of money that you will need in less than 1 or 2 years. Chances are that the value of your investments could be at their lowest when you need that money the most. The third strategy is to diversify into other assets that are not as volatile. For example, you can park some of your investment money in stablecoins that pay you a reasonable interest, more so than a traditional bank. Stablecoins are digital dollars. You can earn higher interest rates on crypto banks than in traditional banks. Current yields are in the 5 to 10% range, depending on the crypto bank. I'll explain more about these in another video. Now let's talk about how to profit from volatility. Simple step: buy the dip. When prices are down, simply buy more. That's it. That's the huge secret to profiting from volatility. Just buy the dip. Alright, so to summarize, volatility is the change in price of an asset over time. It tells you how an asset behaves. You can protect yourself by investing for the long term. You can invest money that you don't need in the short term. And you can diversify into another asset if it's too volatile. And lastly, to profit from volatility, buy the dip. Thank you for watching. Hit the subscribe button for more fun videos about finance topics. Thank you.